Hey, what's going on, guys? Welcome back to another episode here on Let It Grow Investing. I'm Jeff. We're going to try to cover everything that's going on in the market and worldwide geopolitical conflict and strife and everything else that's going on in the world. So there is quite a lot to cover. I'm going to get through kind of the main points. I know I was out last week. We had a soccer tournament out of town, and then it was Father's Day. So we got home and did the Father's Day thing. So I did not get an episode out. I was going to try to on Monday, and then the week just hit me. So thank you guys for being patient and coming back for this one. So a lot of different things have happened at that time. We had the Fed come out and say the rates are staying put. We've had Israel and Iran problems, and on Saturday the U.S. Did have that missile strike on Iran's nuclear sites. So just all sorts of things going on in the market. Lots of changes here, there, and everywhere. We've had a pretty solid run. I know a couple things we did have a couple down days, but overall I think we're doing pretty well. I should just go ahead and pull up and see what the actual market's doing. I'll try to get the S&P 500 pulled up for us and bring that up on screen. But yeah, so there's a lot of different things that are going on, that are really just going to be a very tumultuous market, and we really got to figure out what that is going to look like here. So I'm going to share my screen. We're going to take a look at the S&P 500, and I want to talk about a couple things. We'll get over this one though. This is the 1 month. We are this week, the last 5 days was a little bit of a downtrend, but overall, over the course of the month, we're from a low of about 5,800 up to about 6,045, and then we are kind of pulling back a little bit. So overall, pretty solid. Although this past week has been a little bit down, I do think that going forward, we are going to get some downtime for the next couple days. We're going to have a lot of uncertainty out there, and the market just does not not like to deal with uncertainty. So picture-in-picture mode. All right, cool. All right, just pop-ups on the screen here. We've got a lot of different things we're trying to figure out, right? We're trying to figure where we can invest, how can we stay safe. I know some people are going straight to cash. Some people wish they sold everything Friday. Some people are looking at what can I buy to go ahead and take advantage of this market, right? So I definitely think there's a plan for everyone, and not everyone's going to fit the same. So I will talk about what I'm doing. I do want to talk about risk versus reward as to what you're buying. That is going to be one of the main points of what I'm looking at today. But yeah, it's definitely a geopolitical uncertainty that is really going to be, driving this market. So tends to be when we have a war, it is a short-lived downturn for one of these type of short-term type conflicts, right? Ukraine, Russia problems, the market sold off for about a month and came back, fairly quickly, right? I'm looking at that. I'm trying to see where we are at in this timeline and what we can do here. And I think we might have a little bit of a buying time for those that want to stay invested long term. If you are a trader, might not be, the best time to plan on longs or things going up, unless you're looking at oil, defense, things like that. But other things in the travel space are probably going to be hurt a little bit more, right? We're going to see oil prices go higher, which means that airline prices are going to go up. They're not going to have that cheaper fuel that they're used to. So they're going to be more oil sensitive. So we got to think as to where we want to go, how we can play it, and really where the value is, right? So when I'm looking at value, when I'm looking at a stock, we like to think about risk versus reward, right? And that comes up frequently. So I'm going to share this one. This was for Lockheed Martin, right? A defense contractor that I'm sure is going to rally, man, crazy tomorrow. That's just my 2 cents here. So I'm looking at a stock like Lockheed and thinking, where I'm already in this one. I'm probably not buying any, but where would you want to buy this thing, right? So we've got a trailing PE of a 20. We've got a forward of a 17, which is pretty fairly valued, right? So we're going to go down. I do want to get back down to that PEG ratio. We're going to try to make heads or tails whether or not this is a buy, right? So this earnings for the past quarters is trending down, but as we get through 25 and into 26, that earnings is going to be coming back up, which is nice to see, but the revenue is not anything to write home about. I think it was 4% and 8% We've got around 13.5% of price target upside, average being 533. We've got annual revenue, 4.7%, 8.6%. But what actually makes it down to that EPS, the earnings per share? That is what everyone wants to know. This is how much they bring in. That earnings is what they're left with, right? So that is really where we want to be looking. Yes, increasing revenue is great, but if it doesn't make it to the bottom line, it doesn't really mean all that much. I mean, definitely means that they're doing something right, but if they're spending more to make more, we might have another issue there, right? So we want to be aware of how much that earnings is actually getting to the bottom line. Dividend growth, about 5%, currently yielding around 2.8%. Payout ratio is okay, 56%. We're looking for under, depending on the industry, 60 to 80% on that dividend payout ratio, meaning that they aren't spending too much on dividends. They can reinvest it elsewhere. We are looking at forward PE, a little bit rich at 5%. I'm not overly concerned with that. It's still cheaper than the S&P, which is going to be a 22.6 average amongst those stocks. But now we get into the other numbers here, right? I love to look at this PEG ratio. It's going to be the forward PE divided by the 5-year forecasted growth rate. So we are looking at a company that had a 17 PE, and then we're looking at, the growth rate. It doesn't actually break it out, but you can do the math. So this is a forward. The PEG is going to be at a 1.2. So it is growing very substantially, right? We're not looking at if it were at a 2, based on a 17 PE, we'd be looking at 8.5 on percentage of growth. So this is going to be growing more. So a 1-to-1 would be a 17 over 17, right? So you got a 17% growth rate. You can do the math. I'm not sitting at a calculator at the moment, but it's looking like a better entry point, right? Especially with that 5-year average being a 2.5, meaning you are paying more than what the S&P average is going to be in order to get in that stock. Why does this matter? Well, a lot of it is to do with risk reward, right? The value investors, the big money managers that are best investing in value portfolios, want to get in at a lower PEG ratio. They're going to be buying it when it's at a 1. They're not going to be buying a stock that's at a PEG ratio of a 2 because they are paying too much for that growth. That's not to say that some of these stocks might not, just hit this trend or be in a lot of war, a lot of strife, and LMT goes, above, right? We could definitely see that. So don't think that, just one number is going to, be the end all be all of everything. But this does show me that we are entering at a spot where we are forecasted to get more growth than what we are paying on a price earnings multiple for that given stock, right? So it's under half. So I do think that Lockheed's going to rally. I don't think that it's going to be sustained for the long term, right? I don't think that, history generally kind of rhymes or repeats itself or whatever you want to call it. So I don't think that this is going to have staying power of Lockheed price being elevated to a new PE high, say a 25 or a 30. I don't think that's going to be the case. Am I going to buy it on Monday? Probably not, because I think that other people are going to be euphoric about trying to get into these defensive contractor names. I think too late, right? I think you should have been in this thing as things calm down from Russia, Ukraine, as that kind of got out of the media. I know it's still ongoing, but as it kind of calmed down in the media front, I probably would have got some then. And then be ready for the next, event, turmoil, whatever, military spending. I know there's military budget cuts that they were looking at. I don't really know where we stand with that, but I will say that if you're buying it, just chasing this thing, expecting it to just keep on running and running, history says that does not happen. Conversely, if we're value investors looking to invest in a stock with like a 1 or a 1.2 or even, half of what they historically trade at, where would that value or the growth investor be looking to sell? Typically speaking, anything above what the S&P is, right? This is going to be above a 2. So if they are overpaying on that price earnings multiple for the growth that the company is actually providing at a level of a 2, which would be 10% EPS growth versus a 20 times forward PEG, that would be a 2. Right? So we don't want to be investing in these companies that have a 2, or they're valued at a 2, thinking that it's going to go to a 3, right? Because now you're getting really risky. You're looking at all these growth hedge fund investors looking to get out of it because they've already made their money on it. So when would you enter back in, right? That would be potentially where the value investor is getting back in, which would be that 1.5, definitely sub 1.5 for a true value investor, right? So you're looking at these numbers. You're trying to figure out, where can I buy it? Do I want to buy it and chase this trend? Specifically in this situation with, US, Iran, Israel problems, do I want to chase it? And I think that is a no. I think that's how you get hurt. I think you get blindsided to the fact that LMT's got to make more money. We have to spend more on bombs, right? That is going to be short lived. I don't think that that's going to be the big driver here. So, will it affect it tomorrow? Yes. Will we have sustained growth for the next 2, 3, 4 months? I don't think so, because there's already so much of a backlog for General Dynamics, for Lockheed, for Raytheon, for L3 Harris, for did I say General Dynamics? All of them already have a backlog, right? So there's only so much that they can actually produce more of, although people are going to want to be buying it. So yeah, that's where I'm at. That's what I'm looking at here, right? So if I'm looking at other stocks, this is going to be for Apple, right? Apple. I'm looking at this one, and we're looking at a forward PE of a 26.9. We are looking at a forward peg of a 2.1. Yes, it is under their 5-year average of a 2.6. Why? It's not really to do with the forward PE value, right? So it's going to be more on that actual growth side. People were willing to pay more on the price side because they were able to keep churning out growth. Right now, they're not doing as much growth, right? We're not seeing the numbers that Apple used to do. Annual revenue is increasing 4% this year, 10% by the end of next year. That's single digits for both years. We are looking at earnings per share slightly going up, right? About 675 in 2024, 17 in 25, and 778 in 2026. So yes, I would have to go back and take a look and see what these numbers are actually trailing from. 2023 was a 613, so in 24 up to 675, we were up 62 cents. Which is going to be less than what it's going to be in 2025, and then probably return to that growth number in 2026. So why is this thing just kind of in limbo, right? If I get back to this one, yes, it's got about 17% upside. Yes, it traded down on Friday. I think there's a lot of different concerns here from tariffs, right? I don't know that production in India is going to work as well as they think, or how those tariffs are going to impact them. That is a problem. The other big problem is the fact that the iPhone has been their bread and butter for 10 years, and they really haven't done anything other than that as far as innovation, right? They've had the computers, they've had the laptops, the iPads, some of the wearable devices have been doing better, and the app store has been, kind of a point of contention with the lawsuits and people not getting their cut of what they need, although it does have a lot of driver of growth for them. So there's a lot of uncertainty there. We're not too sure about the tariffs. The fact that it is trading at a 2.1 isn't really getting enough people to want to buy this thing, right? So where is that point where I think that investors are going to come right back in? And if we look at history, right, I'm looking down here at this forward peg ratio, right, back here in 2021 at about a 1.3, maybe I'm going to call it. That's where we started buying. We kind of touched on like a 1.6, 1.7 into probably the beginning of this year. I will say, if this is 24, I'm guessing this is 25. So we were sitting around a 1.7. So I think investors kind of picked it up from here, and we got it up to this 2.1. But I don't know that we have the driving power to get back to this 2.6 right here, right now, right? 23 was a big year for them. And I'm trying to think why that peg ratio got so high there, but then it fell off like a rock. And this is not what I want you guys to do, is buy this peak and then just have this thing come crashing down, back to reality land, right? So that is not where you want to be either. I'm not saying that buying Apple at a 2.1 is a terrible idea. It is cheaper than the 5-year average, but I'd rather buy it at a 1.7-ish, right? And if I'm looking back, let's pull up Apple real quick. I'm going to go ahead and get back to their page. We're going to see just what happened on this chart. If I go year to date, and we see 230 This might have been like this April drop where we got down to like 169, 170 April 8th. That was probably when this peg ratio just collapsed, right? So we're kind of looking at that. We're trying to see where do we want to get in. And I think that is the point where for Apple, if you're looking at that peg ratio, like that 1.6, 1.7 is probably a great entry point for a long-term hold. Now, does that mean it's got staying power for everyone? No, but I think for Apple, it does have a good entry point, right? I think that could be a good spot to look at what history has said, see when everyone else comes back in and buying on these dips, and maybe that's where you set it, right? We're not setting it, oh, Apple's at 201, I'm going to buy it at 180. Like, where did that come from? If 180 is a number where your PE, your forward PE, your growth, everything else kind of lines up, yeah, go for it. But if you're just throwing, I want it 10% cheaper, so I'm going to buy at 180, why? Is that what history shows you? Is that just a number you're comfortable with? Or is there really a reason why I want to buy at that given point in time? And for me, if I'm being a value investor, I want to get in at that right price points. 180 is just, seat of the pants. That's what felt right at the time. But if I actually go back, I could say, hey, yeah, 169.21, we were trading at a peg ratio of a 1.6, 1.7. That is where I feel really comfortable getting into this thing. Not to say you shouldn't buy now, not to say that this thing won't go to 270 within a year. I don't know. But I'm saying if you're a value investor looking to get the deal, I think that is potentially where you want to be. So yeah, we've got around 13% of upside. If I look over at LMT, let's take a look there. We're trading at a 470. We got around 11% of upside. This thing is going to run tomorrow. I already know that. Oil should probably do really well tomorrow. Like I said, travel is not going to be great from the cost of oil going up. It's going to be a tough one, right? So we know these things. I did pull up Netflix as well. Let's go ahead and get back to Netflix and share this thing. So yeah, this looks a little bit different, right? We've got a forward PE of a 45.8. This is trading at a premium to its 5-year average. So this would not be one that I'm looking to rush into. Yeah, you're going to get the stories of, yeah, we can't afford to travel right now, so everyone's just going to stay at home. They're going to be signing up for more Netflix. They're going to be doing less travel. We can't afford oil. There's a war, yada, yada, yada. So maybe there's a trend that's pushing this thing to 2.2, but I'm thinking that it is not a great time to buy, right? I don't think that there is a good reason as a value investor to buy this thing. Yeah, you might get a short-term blip that not as many people are traveling, so we're going to buy some more Netflix, whatever. But for me, at a 2.2, it does not make as much sense. Where does this thing ultimately go? I mean, we saw this thing rise up to a 5, and then what happens, right? Same thing as what we saw in Apple. It comes crashing back down. So I don't want you guys to get hurt and think that, hey, yeah, buying above the average, well, it's going to get to a 5, but then you got to perfectly time this then to get back out of it before you just get walloped. It really is just that simple. If you're buying it cheap meaning relative to the growth, relative to the price, not simply just the number on the stock dollar amount, I think you're going to be a lot safer, right? So trading under here, under this 1.7 is a much better entry point to get in on something like a Netflix. Now, this isn't going to work for companies that don't have an earnings, for the new stocks, for the growth stocks, for things that really haven't had that long-term projection as to what their 5-year looks like. It's going to be harder to figure out. There's going to be companies that are more volatile. There's going to be a lot of different things that you have to take into account. But for some of these, a lot of the bigger names that have been around for a lot longer that have positive earnings and we continue to grow, or even if they don't continue to grow, but they still have earnings, I think that is going to be a great way for you guys to be a lot safer knowing whether or not the risk is worth the reward, right? So for Netflix, I do want to pull up the actual, and we have great revenue growth. 14% on 2025 and 27.9 by the end of 26. That's around 14% per year, which is great, right? I do like that, but I would like to buy this stock at a cheaper price, right? So analysts agree with me, right? They want to see this thing lower. They want to see this thing. They see this thing coming down to 1190 from 1222. as of, I don't know what date this was actually published on, but they do see this thing coming down. So your upside is limited. And I didn't even look at this to show you guys this. I'm showing you what I think based on the growth and the price earnings, that I don't think that this has upside. I think that this has more downside than anything. So again, I mean, could it go up? Could it keep running? Yeah, it could. But eventually something's going to catch up with it, where a little blip in the radar is going to send this thing tanking back to a peg ratio that is where value investors are going to start buying. I hope that makes a lot more sense. So yeah, look at the peg ratio, look at what's going on out there. Let's go ahead and actually get back over to Netflix on E-Trade. I want to show this one instead. So we were at 1231 on Friday. So this numbers were probably from Thursday. Very little upside. Yeah, we got people saying that it's going to 1600, and it might. And we also have people saying it's going to 950. So yes, you have a little bit more upside if you listen to the top price points, but you also have very significant downside if it goes the opposite way. Let's conversely look at what it says for Apple. And Apple has a lot more upside and significantly less downside, right? I still don't know that a 2.1 is exactly where I want to buy Apple. I would much rather have it at a sub 1.7 or whatever that number was. But I really do think that, Apple is in a bit of an unknown when it comes to tariffs, when it comes to what's next, when it comes to what we're going to see new products from them in September. So there's a lot of different things at play here. It could be a decent time to get this thing, right? They could announce something new, and then that growth number is going to change, right? So if that growth number changes and they say, hey, we're going to be able to increase our growth another 10% for the next 5 years, then that peg ratio is going to get altered. So you've got to take a look. You got to be kind of in tune with what your companies are doing, right? If you know that Apple is due for something, or they hired some new talent and they're working on something else, maybe they're trying to get into more AI, they're leaning into that heavily. Maybe that is going to be that next growth lever that Apple's going to be able to pull. Maybe that's going to be the next thing for them. But it doesn't always work like that. LMT, yeah, I was going to say, I really don't think there's going to be much downside when it comes to LMT. 27% of upside, 1% of upside on the low. So I'd feel comfortable buying Lockheed. I'm not going to buy it when it runs up to about 500 tomorrow. I would wait for it to come back down, because I think it will. I don't think the long-term trajectory based on this Iran-US is going to have the staying power that some people think it's going to have when it comes to euphoria in the market. And I do believe a lot of people are going to be chasing these stocks because that's what they feel is going to be the best way to make money right now. General Dynamics, a little bit of upside on average, 6%. Let's check with LHX, L3 Harris. We've got very little there. So that one is probably, maybe I even think about selling that on some of this news. That could be a good play, right? If this thing gets a 5, 6, 7% run up, maybe I take some out of there and I have some cash on the sidelines. That could be a solid play. What else? We got RTX. Let's see what Raytheon's looking like. Negatives. So we don't really necessarily want to get in there. So maybe the one that I had pulled up, Lockheed Martin, might be one of the better bets. And again, I'm looking at these things, assuming that the analysts have done their homework when it comes to the peg ratios, when it comes to the values, when it comes to the growth. I do think that we're going to see some of these run up, but I don't think it's going to have staying power. We also have Bitcoin that is going to be collapsing. So let me go ahead and take a look at just what Bitcoin is doing. I'm going to pull up my crypto.com app. I don't think that E-Trade has spot pricing on crypto. But yeah, Bitcoin did break the $100,000 mark. It went down to about 99.5. And now we are sitting at 1,924. Yeah, when it comes to Bitcoin, I really don't think that it is going to have a massive drop in price here. I don't really know that the correlation between war and crypto is going to have this significant long-term effect. So I do think that people are going to run back to buy crypto fairly quickly. I don't think that it's going to be even as long as what the defense contractor stocks are going to be or what the S&P 500 as a whole is going to be, right? So if the tech stocks do trade off on Monday, based on the fact of a lot of uncertainty out there, which still doesn't really make sense to me. I mean, especially with Iran and the US. I mean, there's going to be some problems, but I really don't think that that's going to be an end all be all when it comes to anything tech related. I think the whole market's going to have a little bit of a pullback, but I think by the end of the week, we're going to start buying some of these things back, right? I think there's going to be money on the sidelines that's ready to pull the trigger. So I'm thinking if you have some stocks that the valuations really start to make sense for you, it could be a good time to get in on some of these names. That's not to say that we're not going to have some volatility out there. I definitely think we are. But yeah, definitely do your homework. Definitely have that pencil sharp. Know your shopping list, right? I mean, I've got the list here as to what I'm looking to buy for the year. We've gone off that chart for quite some time when it comes to the investing challenge. If you are new here, I know there's a couple new people that I've been talking to that might be new here. I'm investing $200 of my money every week on Mondays for the past, this is year 4 of this now, guys. We are north of 40 grand in that account. It's about $10,400 per year that I'm investing into a Webull account. If you do need help getting started, I do have a link for Webull. You'll get some free fractional shares when you invest. I think the number is $500 right now. Do not quote me on that. But you will get free fractional shares by simply opening an account, funding it, and getting some money going. But I mean, what I'm looking at this year, NVIDIA, Tesla, Meta, Amazon, which I do want to buy more Amazon. They are leaning more heavily into AI, which I think is going to change their growth rates, which should help that PEG ratio be more in our favor as those growth rates come up to where that they're closer to that PE, right? Then it's more that one-to-one relationship. That's what we want versus having the PE up here and your growth rate down here. So once they get closer, right, you're more at that one-to-one relationship, and that's really where you want to be buying. But I think that Amazon is going to get those growth numbers up. And I think that I want to be ready before the investors, those value investors, see that closer relationship on that PEG ratio. So I will be probably, okay, I'm just going to go and buy that one tomorrow. I'm buying Amazon tomorrow. Let's go ahead with that. But yeah, Eli Lilly, still love it. That has came down a little bit. I still think that's a great stock to buy long term. Next Era, still a great stock. Definitely a little bit more comfortable right now versus some of the other unknowns out there in the market. We are always going to need energy. I'm still seeing a lot of people pushing for nuclear energy in the way of like SMR. That is still a big name that I might start position in. CrowdStrike, we're still looking at that. That thing kind of got away from us. Costco, still love it. That's probably a own it, don't trade it. Bank of America, still growing. AMD, looking solid. Man, AMD, we should have bought more of that a while back when it was sub 80. Let's see if I can pull this one up for us. We're going to take a look again at AMD and just see what that is doing. Let us bring this one up. So yeah, we've got very limited on this upside now, right? But when this thing was at 80, down in the table saying, I'm buying this. You can do whatever you want. But when it was down here, that was the time, right? This was the time to buy this thing. So, we've gone up around $43 in the course of 2 months, about 50% of a return in that short amount of time. So hopefully you guys got on that train. I told you I was probably buying this at 120. I think I bought it like 128. I bought it all the way down. I bought some more down here, and I probably bought a little bit down on the way back up. But I'm not buying any at the moment. My position is pretty full, meaning I don't want to add any more weight of AMD to my portfolio. So, yeah, that's what I got there. We're still seeing some buy ratings. I don't know that, the PEG ratio is going to be exactly what we're looking for, but just out of curiosity, let's take a look here at what Refinitiv is saying when it comes to. Let's share this one. Sorry. We got Refinitiv looking at a buy. Let's go down to the numbers that we were just looking at to see what is going on here. Let's see if we want to be buying this thing. Yes, I know this is 4%. We're not really so concerned about what the analysts just say. We're concerned about what our homework says. Revenue, it's up there with where Netflix was, 20+% per year. The growth on it has been pretty substantial. The the 350 chips are coming out. Those are rolling out. Forward PE is actually at a discount. So if the growth rate is at a 15, that would be a 2 peg. If it is higher, we will get underneath of that. So we are at a 1.1. So this is growing almost as much as the PE, right? So the PE is at a 31. And we have got to have growth numbers that are almost at 30% per year to get a forward peg ratio at a 1. So it is trading under its 5-year average. Has had, but granted, when we look back at April now and we see this thing trading at a, what was it, an 85? This would have been at like a 0.7, 0.8, and that would have really, really been the time where those value investors come back in and buy this thing up, and we got this thing rallying quick because of the drop that it was giving. So I still think based on a peg ratio, it's good. We're going to have to see what the growth numbers mean from their new chips and then the 400 chips that are going to be coming out next year. There's still going to be a lot of uncertainty around all the problems in the chip space in the world and who's building what, where, and who's going to be allowed to buy it. So there's a lot of uncertainty there as well. So the fact that the revenue is growing really strong, the earnings is going to be growing really strong when we look at these numbers for 24. So this was a decent, 70 cent jump from 23 to 24. Now we're going from 331 to 387. And then 2026 is going to be massive. We're going from 3.87 to a 5.69. So that is a huge, huge number of growth from this year, potentially in 25 being at 3.8, going up almost $2. $1.80 anyhow for 2026. So I'm thinking that growth rate of that 30%, if these numbers are anywhere near close for 2026, I still think that this is going to be a stock to buy and hold until at least that point, right? So then we've got to be taking a look at what 2027 numbers look like, what the growth looks like going forward. So a lot of different things to unpackage here. Yes, this is a stock that just had a $40 move in the course of 2 months, but I'm still thinking that it has a lot more to go, right? It really, really does. And I think we're in the beginning innings of what is happening for AMD. I could still see the argument to buy more. And looking at these numbers, I might buy more. But in the meantime, we're not going to be buying AMD. We're going to be buying AMZN for tomorrow. And, I'm going to go back to that one real quick. I do like the fact that they are leaning on more into AI. We've got this thing that has traded down. We're kind of in the middle, definitely more towards the bottom here or towards the top of this 52-week range. But I do really like this stock. Do we have upside here? We've got 15.6. That's fair. 7% on downside, 45% on upside. And just because we're doing a whole episode on risk versus reward, let's go ahead and pull up this one. And we're going to take a look at just what is going on for Amazon. Firmly in buy territory. We know they're getting more into AI. They got 14% of upside on the price target. Doing okay. It's not what AMD is doing, but it is moving up nicely, about 60, 70 cents for 25 and another $1 by the end of 26. So we'll take that. Annual revenue 8.9 and then 19.3 by the end of 26 for those that are listening, not watching. And then we've got forward PE at a significant 44% discount, right? That is huge. And then let's take a look at, so we got a 34 on PE. We got a 1.9 on forward PEG, which is tied for its 5-year average. Now, I did say that I do think that their growth rate is going to be going up as we get more into AI. Oh, while it is even for what its 5-year average is, I do think that these growth numbers are going to be changing soon. So I think that we could still get a value by buying now before those growth numbers really get ramped up. So that's what I'm looking at. I mean, price to sales is a little bit high. It might not be the perfect stock to buy. I do think it's going to trade down with a lot of the other tech names tomorrow. So I'm still comfortable with that. I would still buy NVIDIA. I would still buy AMD. I would buy a lot of these different names right now. So hopefully you guys have a sharp pencil. You got your shopping list out there. You know what you want to be buying right now. And hopefully some of these values come our way, right? I'm taking a look at it from the standpoint that I want to be able to invest in things when they come down. And we can only do that with some red days in the market, right? So if the market does kind of give us a little bit of an entry point, hopefully we can take advantage of it. So that is all I got for you guys today. Please make sure you like, subscribe, and share. Thanks for stopping by. Let it grow here with me. And yeah, thank you guys. And I will catch you in the next one. Take care.